Hello, good morning children. Welcome to today's session of online class of Sri Gokulam Guruvayur. Children, today in our accountancy class we will discuss about share capital. We have already started this chapter and we have discussed few of the concepts related to this topic. Now in today's class some more important terms and information I will like to share with you. So be ready and listen to the class properly. Children, today we are going to discuss the topic accounting for share capital. We have already started this chapter and we have discussed some of the concepts related to share capital. Now let us discuss in detail some more concepts related to this topic. Today we will discuss about share capital of a company, kinds or classes of shares which are known as preference shares and equity shares, and the difference between these two kinds of shares. What is the share capital of a company? Share capital means the amount that a company receives as a share capital from issue of shares. So when a share is issued, it can be both preference shares or equity shares. So when we issue the shares and we receive the amount, that part of capital is known as share capital. So what is a share? Share is a unit in which capital of the company is divided. Kinds or classes of shares. There are two classes of shares. They are preference shares and equity shares. As the name suggests, preference shares means they have certain preference over equity shares. What are the preference of preference shareholders? There are two preferences or privilege that preference shareholders have. The first privilege is preferential right to receive dividend to be paid as a fixed amount or an amount calculated at a fixed rate, which may either be free or subject to income tax before it is paid to the equity shareholders. So here preference share is getting the dividend. What is dividend? Dividend is the profit amount that a company share with its shareholders. So dividend is the profit which a preference shareholder receive, and how they receive it? In a fixed amount or as per the calculated fixed rate. And the important thing is they get this amount of profit or dividend, what we call, before it is received to equity shareholders. That is the privilege given to the preference shareholders. The second right of preference shareholder is right to receive payment of capital on the winding off of the company before that of the equity shareholders. So capital in which the preference shareholder is also have contributed their money, they will get back that capital at the time of winding up of the company before it is paid to equity shareholders. So who will be number one to receive that before equity shareholders? It's preference shareholders. So these are the two rights which preference shareholders has. There are actually four broad classifications of preference shareholders. That is it with reference to dividend, reference to participation in surplus profit, reference to convertibility, and with reference to redemption. Let us discuss in detail. With reference to dividend, there are two types of preference shares, that is cumulative preference shares and non-cumulative preference shares. Cumulative preference shares means those shareholders which carry the right to receive the arrears of dividend before dividend is paid to the equity shareholders. Here arrear means in any of the year, if the company is unable to make the dividend to the shareholders, that is known as arrears. So the preference shareholders will get the accumulated arrear before it is paid to equity shareholders. So that is the first advantage. Then the next type of dividend is non-cumulative preference shares. Here the preference shareholder will not receive such benefit. Okay, so there are two classes of preference shareholders: cumulative preference shareholders and non-cumulative preference shares. So this come under the category with reference to dividend. Now with reference to participation in surplus, that is profit, they are again classified. Preference shareholders are again classified into two: participating preference shares and non-participating preference shares. Participating preference shares means what? The article of association of a company may provide that after dividend have been paid to the equity shareholders, holders of preference share will also have a right to participate in the remaining profit. Children, once the profit of the company have been calculated, they will distribute it to the preference shareholders first. Then they will give the with the prescribed ratio or prescribed percentage, they will distribute it among the shareholders according to the shares held by the each of the shareholders, that is equity shareholders. If any amount is left, again after all the distribution, any more amount is left, that will be again distributed to the participating preference shareholders. Okay, so that is the right which preference shareholders have they can that is the right which they receive. So preference share carrying this right are called participating preference shares. Non-participating means they will not get any dividend, that is remaining dividend after the equity shareholder have been paid dividend. After paying all the dividend to equity shareholders, if money is left, the non-participating preference shareholders, they will not get the money. Next category of preference shareholders are with reference to convertibility. There are two types of preference shares: convertible preference shares and non-convertible preference shares. Convertible means what? It will get converted into something else. So preference shareholders which carries a right to convert it into equity shareholders. So if preference shareholders, they no more want to be in the list of preference shareholders, they have the right to get converted into equity shareholders. And what do you mean by non-convertible preference shares? Non-convertible preference shares, they will not carry any right to get converted into equity shareholders. The only difference between equity and preference shareholders is they have some benefit, that is preference over the equity shareholders. Now with reference to redemption, what is the meaning of redemption? Redemption means the payment of the amount. Okay, so with reference to redemption also, we can classify preference shareholders as redeemable preference share and irredeemable preference shares. Redeemable preference shares are those preference shares which are redeemed by the company at the time specified. That means the capital amount of preference shareholders will be paid back to the preference shareholders at the time specified. That may be 20 years or more than that. So as per the decision between preference shareholders and the company, it depends. So as per the time specified, if after that time the preference shareholders will get back their money which they have invested in the business. So that process of giving back of the cash which is invested is known as redemption. So that is redeemable preference shares. So redeemable preference shares means the company will make payment after this time specified. Now irredeemable preference shares means those preference shares, the amount of which can be returned by the company to the holder of such shares when the company is wound off. So actually the meaning of redeemable preference share is the preference shareholder will get the money only when the company will wound up. Okay, get back their capital amount only when the company will wound up. But as per the Companies Act 2013 does not permit issue of irredeemable preference shares. So Companies Act have cancelled such right to the preference shareholders. Now that was all about the preference shareholders. Now what is equity shareholders? Equity shareholders are those shares which are not preference shares. Stating differently, shares which do not enjoy preferable right of receiving dividend or repayment of capital are called equity shareholders. So equity shareholders, they will not get dividend at first. Who will get the dividend at first? It's preference shareholders. So they will not get the dividend at first. And the second thing is, they will not be given the capital amount also. Only at the time of wound, or when the company gets a wound, that is it shut down its working, at that time only the capital will be paid back to the equity shareholders. So these two rights of dividend receiving and repayment of capital will not be enjoyed by the equity shareholders. Equity shares are the most commonly issued shares and carry the maximum risk and reward of the business.